Expert Michael Avery, the head of markets research Asia Pacific at Rabobank, joins us on the phone line from Hong Kong. Good morning, Michael. I really wish 2016 began on a better note. At any rate, here's wishing you every happiness in the new year. What have you made of the mix of data? Do you think the markets have dithered and shuddered and the data is in the price? Or do you think that there is still a lot more of discounting to be done?
Well, obviously it depends if you're looking at an individual market or if you're looking at the global big picture. But if you look at the global big picture, then my view personally is that the data are extremely disappointing and that the equity markets are nowhere near factoring in just how unpleasant the underlying picture really is globally, as I said. Individual markets, India, for example, may offer a counter trend or a relative outperformance. But I'm afraid what we saw at the beginning of 2016, even though it doesn't look like being replicated so far this morning, is nonetheless likely to set the tone for the overall year.
Okay. Michael, hi, good morning. So what is your own prognosis for, say, the first half of 2016? Is it too early to call this the start of a bear phase for global equities, or do you think that is how it's going to play out?
Well, I think that's exactly how it's going to play out. Frankly, equities have been living in la-la land for a long period of time, being driven by liquidity rather than fundamentals in most cases. And what we have now is a global backdrop where the data continue to deteriorate in far too many places. And at the same time, global liquidity is going to be tightened by the US Federal Reserve. So it's the worst possible combination. And I really fail to see how anyone can expect equities to do anything other than suffer / tread water in that particular environment. You have to be, a congenital optimist or someone who's trying to sell equities, I think.
Okay, strong words, Michael. But really, fund managers do have money. In India as well, the retail money has been coming in well and properly for fund managers, even if foreign money hasn't been coming in. As a person advising global markets, market men, what would be an asset class that you would prefer?
Well, I mean, it really depends on whether you think inflation or deflation is more likely as the global backdrop. And let me just sidestep the question just for a moment to say, of course, people are still continuing to, give money to fund managers, and fund managers are always looking to put money into things. On a personal basis, so do I. But just because I've got money to put into something doesn't mean I'm prepared to overstretch in terms of valuations or to unrealistically think that something will appreciate 6, 7, 8% when fundamentally the global economy is deteriorating. But in terms of asset classes, I don't think equities are going to have a particularly good year this year. And ironically, I think there's probably a slightly better chance that fixed income might have a better year. Now, that may sound surprising, particularly with the US raising interest rates. But if they do that prematurely, and if we continue to see signs of underlying deflation and yields grinding down at the longer end of the US curve, you may be surprised. You may actually find that you get better value for money from fixed income than you do from equities, which is obviously not what equity salesmen are going to tell you.
That's not the best prognosis for us equity watchers. But I guess the question now is, will we sell off less than the other markets? By we, I mean India.
Well, I do think that is the case. I mean, what I'm saying sounds, hideously bearish, I know, but I try and tell it as it is. But I think India actually does have stronger underlying fundamentals than many other markets. I'm not talking in terms of actual valuations of particular equity sectors, because some of those do look stretched. But I think in terms of what the prognosis is for underlying growth in India, there I'm far more optimistic than I am on many other places. And so on that basis, yes, I think India can relatively outperform. And as I said yesterday, if you're nursing losses of, say, around 2% for the first day of the trading year, you can thank your lucky stars you weren't in China, where you would have been 7% down.
Well, actually, what are you expecting from China? Today, the currency itself has been fixed a little higher than where it ended yesterday at 6.51 compared to yesterday's close of 6.53. Are the Chinese jitters over for now, or are we going to see something like June 2014?
I think we're going to see a repeat. I mean, it's not going to happen every day because nothing in markets ever moves in a straight line and nothing ever continues day after day after day without variation. But what you are seeing is that, for example, the renminbi fixing this morning is actually significantly lower than it has been for some time. Now, the market actually at the moment isn't selling off anymore, which suggests that there's some kind of intervention happening. But the message from the PBOC publicly in terms of where the fixing has been set is that, yes, this currency will continue to weaken. And on that basis, and with the share market, dipping back into the red again, having been green, I think we will continue to see an echo, if not an exact repeat, of what we saw yesterday going forward.
Hey, not prepared for that encore. Thank you very much, Michael Avery, for joining us with your thoughts. Well, I guess Michael is just preparing us for worse.
Oh, yes, that's quite.